Well, welcome, ladies and gentlemen, to this presentation about protecting your financial future. This is about risk insurances, personal risk insurances, which is a massive topic, I think, for brokers in particular to be discussing and to be thinking about, because this is one of those areas, as I often say at the Independent Finance Brokers Forum, it's one of those areas where you can add some real value for your clients and just add that extra little level of care, I suppose, to the relationship and how you develop that with your clients. I think it's really important. And today's session is all about educating you around the types of insurances there are, the purposes that those insurances serve, and a little bit of discussion about maybe where you can introduce these into the whole program. So to start off with, of course, we have our disclaimer, which is to say that this advice will be more general information. It's for education purposes. And anything specific that you have questions about, I'm very happy for you to contact me about those. And of course, if you have clients that you think would do well to have one of these products, please be sure that you have developed a relationship with a financial advisor. With this knowledge that you're going to get today from this webinar, you'll be able to go and have a conversation with a local financial advisor and hopefully say to them, hey, I've got clients that I'd like to refer to you. I, of course, would be very happy as Intrepid Wealth to also have those referrals, but sometimes the distance or the location may not be suitable for that. So always good to have a local financial advisor up your sleeve or in your back pocket. And let's go to the next slide. So again, today's information, general in nature. What we are going to do, though, in today's session is really help you understand what some of the common personal risk insurance types are, the financial problems they solve, and where they sit in that whole client journey. What we're not going to do is obviously look at any individual personal circumstances. So stuff today is very much general in nature. And yes, you should go and talk to a licensed financial advisor before going too much further than a general conversation with your clients. So there's some assumptions that people have about insurances, and particularly about income. And because this audience largely will be mortgage brokers that are watching this, one of the things we do when we write a loan, of course, is we have to prove that a client can service that loan. And if they cannot service that loan, they don't have income to service that loan, the bank won't give them any money. Rarely, though, does the question get asked, what would happen if you lost your income for a period of time, 3, 6, 9, 12 months, maybe for the rest of your life? What would happen to that family if an income earner ceased to earn income? What would happen if a disability changed your ability to earn income? And when I say disability, I'm not talking about someone who is disabled. I'm talking about an accident, maybe, where you become disabled. So you were previously an able-bodied person. You say had a horrific car crash or maybe a motorbike accident, and you couldn't then work because you were disabled. And then things like medical expenses are often overlooked. People have private health cover, they have Medicare, but oftentimes other types of medical conditions aren't covered by those two things, or you exceed the level or the extent of cover by that insurance provider. So the thing to take away from that is that the insurance that we're going to be talking about today, it won't stop the event from potentially happening. But what it's designed to do is reduce the financial shock that could follow from a really serious event. So following on from the sort of the financial aspect of it, and what are the financial dominoes, even though these are circles, but pretend they're dominoes, is something happens and you stop earning income, or your income level falls because maybe an illness doesn't stop you completely from working, but it might sideline you from working for periods of time, or reduce your hours that you can work. As we all know, the bills will continue to come in. Bills don't stop. We still have to pay mortgages and utilities and put food on the table and all those sorts of things, which is flowing into the next middle circle there, which is debt. And that's, again, what a lot of mortgage brokers would be very familiar with, of course, is our job is to put people into debt. And I think part of our job should also be to help people understand what happens if they can't earn income. And that's what today is all about. We then flow on to our savings. And of course, savings rates are historically low around the world, but particularly in Australia. So could you imagine if you had a loss of income and very little savings, how long would you be able to go before you had completely depleted your savings? And then, of course, ultimately, it results in a loss of choices. Once your savings is depleted, if your income is stopped, your choices narrow substantially and significantly. So that's a rhetorical question that you might even ponder yourself. How long could you go if you tomorrow had something that stopped you from being able to earn income? How long would you last? So let's talk about insurances. This is the one way to, or the way, I would say, to protect yourself and offer that to your clients to protect them. Four main types of insurances. Life insurance, which is, or you could call it death insurance, but it pays on the death of a person. So life insurance or death insurance pays on death. It also, though, will pay on the diagnosis of a terminal illness. We'll talk a little bit about that. And it's really designed to help your family and the people you leave behind, so your dependents, if you have any. The second type of insurance is income protection, and that's an insurance that gives you a regular income stream where you're unable to work. So income protection kicks in after, and again, we'll talk about all of these, kicks in after a waiting period and then covers you up to a certain amount of time. And that's to help you with cash flow, because if you're not working, of course, you don't have cash flow. Third type that we're going to talk about today is total and permanent disability. That's a mouthful to say, so we'll just abbreviate that to TPD. So TPD is where you have had an accident or an illness that has caused you to not be able to ever work again. So you're still alive, you're still hopefully a reasonably functioning human being, but you just can't work anymore, and or you've got some significant potential ongoing medical expenses and lifestyle or long-term lifestyle expenses. And then finally, critical illness. This is the fourth of our personal risk covers that we'll talk about today. So critical illness is where you have, I'll just name a couple, like a cancer diagnosis or a heart attack or a stroke, something significant like that, a real significant illness that's going to cost a lot of money to get treated and will also potentially prevent you from working for a period of time. Good news is with a lot of critical illnesses, of course, is that once you get treatment, you can recover and then hopefully get back to work. And I have had clients that have gone on claim for critical illnesses that, that are able to get back to work after a period of time. So those are the four main personal risk insurances. What I'm not going to be covering today is anything in relation to other types of business cover, which there are some out there like Keyman Insurance and so forth. That might be another webinar that we do if people are interested. Let's get into it. So what is life insurance? Well, as I said, it is life or death insurance, depends on how you want to put it, and it's for when you die. So if, in my case, if I were to die tomorrow, I've got, I think, about $1.5 million or so of life insurance. And the purpose of that really is to pay out my mortgage and leave a little bit of money behind for my family. My kids are all grown up, so there are some considerations when you're looking at these types of cover. One of them, of course, is do you have any dependents, which is that third bullet point there. Not to skip over replacement of lost income, what I often say to my clients, especially young ones, is we want to give you a certain level of life insurance because if you were to die tomorrow, you have lost, or your family has lost, all of the financial wealth and all the wealth that you're going to create over a lifetime of working. So imagine a 30-year-old who, in fact, they'll probably be older these days, let's say 35, and they've just got a mortgage, life is going great, and they die in a car crash. They might have a young family, a lot of debt, and that family has now just lost that person's income for the next potentially 40 years, and all of the things that the income would bring with it, like accumulating assets, superannuation, paying for education, all those things. So there is lost income when a person passes away, particularly at a young age. Life insurance can also cover things like your funeral and estate costs, And the main thing about life cover is that it gives the family that is left behind financial breathing space. So very important. Life cover is probably one of those things that everybody who has a mortgage, in my humble opinion, not giving advice because I don't know the personal circumstances, I say that tongue in cheek, but that's a type of insurance that I think everyone who's in the mortgage business should be discussing with their clients. We touched on total and permanent disability already. So this is where you've had an accident, and unfortunately this person in the photo there is in a wheelchair. Who knows what's happened to them, but they've had an accident where they're I think that's a paraplegic who has lost their use of their legs. Quadriplegic is the use of their whole body. So the idea behind total and permanent disability is it is a lump sum payment. And by the way, life cover is the same. It is a lump sum payment that goes to a nominated beneficiary. Total and permanent disability is a lump sum payment that goes to the insured. So in this case, it would be this person, this woman who's in the wheelchair. And that is because likely her income stopped immediately. Also likely she didn't live in a house that was set up for a wheelchair. So there would have been costs to either modify the home or possibly buy a new one. I imagine there would be ongoing medical expenses and rehab, things like that. So total and permanent disability is money that is lump sum to help reduce or offset or fully pay for not just loss of income, but also the other expenses that often come with a situation where you have become totally and permanently disabled. Just a quick story. I had a client email me. This was, text me actually. This was probably 10 or so years ago now. Just completely out of the blue. I had written a mortgage for he and his wife, and they had divorced, but I heard from him. He sent me a text message thanking me for insisting that he took out life and TPD because he had had a motorbike accident and became a paraplegic. And he pretty much was saying in this text message that if it wasn't for that insurance, and I'm paraphrasing a little bit here, but if it wasn't for the insurance, his life would probably have ended as he knew it. So he would have been reliant on the government for assistance and who knows what else, family. And the burden would have been immense. But because I had written him a policy, he was able to rely on that, which was a great news story for me. And so glad, well, not glad that the accident happened, of course, but really happy that he had insurance and kept it up. Next one is income protection. This is an insurance that I think is kind of misunderstood. And we're going to go through it in a little bit more detail. But basically, the idea behind income protection is that it is a replacement for your income if you're unable to work due to an accident, an injury, some sort of illness that prevents you from working. And it's not designed to necessarily be a long-term replacement of cash flow, although it can be, and oftentimes policies will cover to 65 and in some cases 70, but will cover to 65. And the reason it's 65 is because that's usually when an age pension will kick in, or other types of pensions will kick in to help provide income protection, help provide income. But it does have a few things that you would need to be aware of. There are waiting periods, and those can be up to 2 years. So you can nominate very short wait periods, 30 days, and even longer wait periods. I usually choose a wait period somewhere around 90 days, which is 3 months. So in the 4th month, it would kick in. The idea behind that wait period that I just mentioned to you is that hopefully my clients have followed my advice and have 3 to 6 months of living expenses in savings and set aside. So they don't want to, and I say this jokingly, but you don't want to go to your income protection policy because you broke a fingernail. You want it to kick in when there's truly a need for it, like you have had a major illness hit you unexpectedly or an accident hit you unexpectedly, which they usually are unexpected accidents. That's why they call them accidents. And you really need this cover. And it's so serious that you're not able to get through the wait period and return to work. So you do have to rely on this cover. But that's an important thing when you're talking about income protection. When I talk about income protection with clients, wait periods are always something we discuss. The tax treatment also is important on income protection. So income protection insurance premiums are tax deductible if you own them in your own name. If you own them through super, they're tax deductible to the super because the benefit that is paid is taxable. So it is taxable income. And so that is, again, something, a bit of a nuance around income protection that you would need to know. So again, the question is, well, how many months could your household go without your income? Again, a rhetorical question, but something that is an easy question to ask a client if you are a mortgage broker or finance broker and you're sitting there talking to your clients. And how often now are we seeing examples where serviceability is really, really tight? And people are saying, well, I just got you over the line with a DSR of 1.01 or something like that, which means they have very little margin for error. And so an income protection policy might just be the thing that they should have a discussion with someone about to ensure that they can retain their home. So again, a lot of insurances aren't about stopping or preventing an event from occurring. It is about the transference of the risk once of your financial risk once that event occurs. And that's exactly what income protection fulfills in terms of protecting income. And that final policy we mentioned on our earlier slide was critical illness. And this is a really interesting policy as well. It covers, usually you'll see around 90 to 100 different types of illnesses and traumas and major medical events are covered under critical illness. They're also known as trauma policies. And these policies pay a lump sum to the insured, and they're really designed to help you with immediate cash flow, to pay medical expenses, to bridge the gap between when you had the accident and getting back to work, and maybe even bridge the gap between the accident, your medical care and rehab, and if you're not going to go back to work or going to be unable to go back to work full time, when your income protection policy kicks in. So all of these policies can weave together to form a really solid shield of protection for your family, your dependents, your spouse, and yourself if you have something happen that you're still alive. But income protection policies have changed a little bit in the last few years, so it's always good, again, to talk to a professional about this before you get too far down the rabbit hole with clients. So I talked about lump sums versus regular income, and then just to do a little recap on that, the examples of lump sum policies are, as noted there, your life cover, your TPD, and your trauma policies all pay lump sum. And you can read the list there. They're designed to help pay down debt, cover medical costs, help with any lifestyle things like if you were disabled and you needed a wheelchair ramp put in your home, that sort of thing, home modifications. And they can also, of course, be used to provision for long-term needs. So if there was a surplus of cash, say you had a TPD payout and you didn't use all the money for some of these things, and you had surplus, well, of course, you could invest that money, and you could invest that for a return of cash flow or whatever to help offset the loss of income. Then you have your regular income product, which is the income protection product. And I mentioned just a moment ago that this product can dovetail in nicely to the other three, where if you've had a trauma or an event where you're TPD'd, you'll have the lump sum, and you might exhaust that lump sum, and you might not have income available. And that's where an income protection policy, again, with a wait period of 90 or 180 days or something like that, would kick in and then cover you for the rest of the benefit period, which, again, might be up to age 65 or 70. So those are the two differences between the lump sum and the income. Now, we often get asked, and you hear about people who say, well, I have insurance in my super. And you're going to hear this a lot, too. If you start to have these conversations with clients, they're going to go, oh, no, yeah, I got insurance cover in my super. Now, my view is if you're really doing your job as a mortgage broker, you ought to be asking that client for a super statement. And the reason, of course, is because you want to put an accurate number on your fact find or your client data form as to how much super that client has, because we all know now that banks are asking if you're, I think it's even as low as age 45, they're wanting an exit strategy. And so one of the exit strategies to pay off the debt that I use anyway in my business, is they rely on their superannuation, and the bank's going to want to know what that is. So it's an easy way to get that super statement. But of course, you can also look at that statement to see how much insurance they have and the type of insurance. And this is where, sadly, a lot of the Australian public doesn't understand what they have in super. They just assume that they have this insurance in super, and there are minimums that are required, but they're very low. And so that's, again, a great reason for you to get that super statement. But a couple of things you need to understand about insurance that is held inside of super. Generally, that's going to be your life cover, TPD, and sometimes income protection. The super policy or the super account will pay the premiums, so the individual doesn't have that out of their own pocket. In some cases, like with industry funds, they have what's called a group insurance policy, and the rates can be lower, and they have default covers. And they might even be easier to get through super than individually. And those group policies, and I don't want to get too much in the weeds here, but group policies are usually not underwritten medically until the time of claim. So even if someone says, well, I have insurance in my super, they probably haven't been underwritten. And that can cause problems if there's a claim. So it's really important, in my view, that the moment you start introducing these concepts is, again, as I mentioned earlier, that you have that financial advisor that you can refer this person to and say, you know what, if this is of interest, and I think it should be, I have got the person for you to talk to about this. They'll be able to educate you on all of it and can help put these things in place because they're licensed to give this advice. Really important. Insurance through super, as I was just saying, also has some limitations. Oftentimes it covers lower than what people realize. That group insurance, as I said, is not underwritten until claim time. And oftentimes, too, the definitions that are in those group policies are a lot stricter than what would be known as a retail insurance policy. Really, what I say to my clients is we just don't want to go there. So if a client says to me, I've got all this insurance in super, I'll say, that's great. Is it medically underwritten? Usually the answer is no. And I'll say, we need to get you retail cover because the last thing that I want to have happen is for you to go have an event, put in a claim, and then have to wait for months or have a fight with the industry fund or the insurer that's underwriting the industry fund to get a claim paid. And that's the last thing you want. So retail policies, when they're underwritten, you always go through and do a medical statement, a tele-interview, and it is a contracted policy. It is a contract. The insurance company cannot renege on that policy no matter what happens down the track. So example of that is on a retail policy, if I had a policy written when I was, say, 30, and I've been paying my premiums religiously every year until I was 50, and then I got diagnosed with cancer, and there was a claimable event. The insurance company can't go back and rework the file and say, oh, you didn't tell us that something about cancer or whatever. It's highly unlikely that would occur, and that's why it's important to have the file medically underwritten. And by the way, it's why it's important to disclose any medical conditions that you have to an insurer when you do that. All right, let's just maybe do a little case study. So we have Alex and Priya. They sound familiar. I might even have some clients named Alex and Priya. In any case, they're 38, conveniently, both 38, and they have 2 kids. And there's some information about their household profile, the financial info. And something happens to Alex. He can't work for 18 months because he's had some sort of illness pop up. And treatment costs start to eat away at the family. And Priya also has to stop working as much to look after Alex. And just to pause on that for a second, that's also a situation that a lot of people don't think about is they might think, well, I'll keep working if my partner or spouse gets into trouble, I'll be able to work. And that isn't necessarily always going to be the case. And again, it could be a situation where that person is, bedridden and unable to look after themselves. They're alive and they're sort of semi-functional, but they can't actually do much and they have to be cared for. And you have 2 choices. You can either hire someone to come in and do that, or you can stop working yourself and you can care for that person. And so sometimes the person that's affected by the event, or who the claim would be on, the people around them have to change their lifestyle and their work habits to look after that person. So again, it just, I suppose, highlights the reasons why you would want to have these conversations with clients because there are ripple effects from accidents and illnesses. So again, asking the questions of clients, how long would your savings last if, say, this situation were to unfold? Would some of these costs potentially continue? So if there was an illness that was going to continue on after 18 months because of treatments. And nowadays, people are, sadly, who get diagnosed with aggressive cancers, they can be on treatments for, 2 and 3 and 4 years as they try to deal with that. So it can go on longer than you can imagine. We touched on, working, the spouse or the partner working less because of the care factor that she would need to care for Alex. And of course, in this situation, I suppose you could say, well, all of the insurances might help. If the serious illness was serious enough that it became terminal, life cover is important. This could be a TPD event. We don't have enough information up here to know what has happened to Alex. But it's certainly a trauma and income protection event where initially that illness would probably be covered by a trauma policy. And after a 3 or 6 month waiting period, Alex would start to get some income. So you have that, again, that cascade effect of types of insurances that kick in at certain points in the cycle of the illness or the accident, and obviously death is the final act. So this is really an activity, but because the answers are all right next to the actual events. But just to sort of recap, the death of a spouse or the death of a partner is going to trigger life cover. That's a lump sum payment. A permanent disability or total and permanent disability triggers a lump sum payment to the family or to that person. If you have an extended period of time off work, that's going to kick in that income protection. If you have a serious illness that is one of the illnesses that's defined in the policy documentation of that insurer, you get a lump sum payout. If you have a mortgage and this is probably the most relevant example for the mortgage brokers who would be watching this and may watch this in the future, if something happens that one of the clients dies, then that insurance lump sum ought to, in my opinion, at least cover, at the very least, the mortgage. And you'd probably, if they had a young family, you'd probably want there would be surplus capital to be invested to help the family out. And then, of course, home modifications if there's a disability. We've talked about TPD. And even trauma covers often have a TPD definition in them. So if you have a major accident and you don't necessarily have TPD insurance exclusively, the trauma policies often do have a definition in there that say if you become total and permanently disabled, we will cover that. So there's a few common myths that I often hear in my advice business from people, and I just thought we'd cover off a few of them because you're likely to hear them too as you have these conversations. People go, well, I'm young, I'm fit, these things aren't going to happen to me. And sadly, and I think all you would have to do is just sit quietly and think about this for a minute, but how many people in your circle of influence and friendships and so forth and family have had some sort of issue? Sadly, I have a good friend of mine who lives down in Victoria, who's been diagnosed with cancer, and he's been fighting that for quite some time. He also has had a family member recently die from a disease, and so the idea that it can't happen to you is crazy. And one of the things I picked up early when I was learning how to write advice was to ask people this question, say, well, when you know that you're going to be sick or have an illness or have an accident or die, call me a month before and we'll put all these policies in place. And of course, that's silly to even contemplate doing that because we don't know. No one knows what might happen to us in the future and when the Almighty is going to come and grab us. So the idea that it won't happen to you is a bit risky, in my view, to adopt. This is a good one. Number 2, workers' comp will cover me. Certainly, workers' comp is a requirement that all businesses have, at least in New South Wales, and I'd imagine every other state. The thing about workers' comp, though, is you have to be at work. So what happens if you get injured at home, or you're on holiday, or now it's oftentimes there's the gray areas if you're driving to or from work, but still if you're out and about or whatever. So workers' compensation, great insurance to have, no doubt, but you have to be at work, and it has to be a work-related accident or injury or whatever. The other thing about workers' comp is most workers' comp policies only cover to about 66% of salary. So your income protection insurances will typically get you to about 80% of salary. So it'll go to 75%, and then you get a little super portion that gets contributed to your super, so roughly covers 80% of your salary. So workers' comp policies aren't, they're good to have, and certainly if you have a work-related accident, you'd be wanting to contact the workers' comp insurer. I dare say, though, workers' comp is harder to stay on because of the nature of those types of insurers. They want to get you off workers' comp as quickly as possible. The retail insurers aren't, I think, quite as harsh. People say, well, I have super, so I'm okay, or I have insurance in super, rather, so I'll be fine. And again, we've already talked about that. You really need to know what's in your super. Don't assume you've got a lot of cover. And also don't assume that they're going to pay it because, as I said, they underwrite the underwrite the claim at claim time. So that's something to be mindful of. We've already talked about the I'm too young gambit, people who are young and fit and having a good time in life. I get it. I know the feeling. However, things do happen. And I think if you thought about it, you probably are well aware of people that have had issues who are young. This one is a good one, and it is, these are really expensive. The thing about it is there are ways to structure insurances, and the number of times when I've actually seen people take out life insurance, and there are reasons to do it, but I can't think of too many, but take out life insurance in their personal name when they could have their super paying for that. So you can have a retail super policy, and your super can pay that policy. That's an example of a way to mitigate it's too expensive. And I suppose the flip side to too expensive is, well, okay, what would happen if you lost your income for 6 months? And how long would you last? How much savings do you have? So paying a couple grand a year in insurance premiums, you'd have to go maybe 5, 7, 10 years before you're that much out of pocket that if an event occurred, you wouldn't not just recoup your out-of-pocket expense, but you would be well ahead. So the expense thing, I get it. It is often an objection. And I'm confident to say that there are ways to help alleviate that. And the alternative is self-insuring, which some people do choose to do. But that also has its risks, because how much money do you have? And if you've lost your ability to earn income, you're going to run out of it pretty quick. One other one that's on here as well is the super one, and that is people think, well, I'll just tap into my super. It's harder now to access super for hardship. It's much harder now to access super for TPD and other events. You have to get multiple doctors' notes and all these sorts of things. So it's not as easy as saying, okay, well, I have some super and I'll go get that. And let's face it, if you're a young person, you don't have a lot of super, so it may not be very helpful anyway. All right. A couple more slides. So I often review insurances with my clients when certain events occur. And there's a whole bunch that you could say are events that you would want to review a person's insurance. And of course, the relevant ones for mortgage brokers are a couple of them on this page. Buying a home, obviously. If someone is taking on, and that would include investment property. So let's say they're taking on a lot of additional debt. That should trigger a conversation. If they've had kids, that should also trigger a conversation. I did a whole presentation recently at the IFBF, and my first webinar in this series was on wills and estate planning. I'm not going to go into that right now, but one of the funding mechanisms for your kids is your life insurance policy, which is then translated through the will or transferred through the will into trusts for those kids. There's a whole strategy around that. Again, if a client rings you up and says, hey, we've just had our first kid, and you've written a mortgage for them, I think you ought, the next question after, or the next thing after you say, that's awesome, congratulations, was it a boy or a girl, should be, I think you ought to get your insurance looked at, because now you've got another person relying on you for a very long time. Starting a business is often one. If somebody changes jobs or becomes self-employed, could be a good trigger event to just ask, is there anything that needs to be done? We already covered the taking on debt. And then naturally, if someone's health changes or something happens with a person's health, it's quite interesting, actually, the number of times that I have had a client or a potential client talk to me about their situation and relate to me that they've had a health situation. And I've said, what sort of insurance do you have? And they'd actually forgotten or didn't think that they might be able to make a claim on, for example, an income protection policy or make a claim on a trauma policy. I can't think of any specific example, but I know it's happened in the last 10 years where we've actually had a client who we brought that up when they told us about it, and they were able to go and get a claim back paid based on what had occurred to their health. So even something as a throwaway comment like, oh yeah, I was really sick last year and I was off work for like 6 months, is worth pursuing a few more questions or asking a few more questions to say, tell me more about that, and what sort of insurances do you have? And so that kind of flows into this slide, which is, what questions ought we be asking our clients, or yourselves for that matter. So what cover do you already have? Where is it owned? And these are questions I would be asking, but certainly this is not advice, and you could ask these questions as a mortgage broker. It's just fact gathering. How much insurance do you have? The what events are covered is probably less important, because that'll generally, when they tell you the type of policy, if it's life cover, obviously it covers them for death. If it's a trauma policy, then you now know that there's anywhere between 85 and 100 different events that are covered. They might not want to ask you or tell you about exclusions. So sometimes people have health issues that get excluded on policies. They still get underwritten, but the insurer might say, well, because you had this illness 10 years ago, we're going to exclude that. Classic example of that is someone who's had, for example, a skin cancer like a melanoma burned off, which is happening more and more these days. If they didn't have insurance before, you would obviously disclose that when you did the medical underwriting, and likely the insurer would say that we won't cover you specifically for melanoma, which is a bummer because those can often turn into worse types of cancers. But in any case, it's better to have all the other stuff covered at least. Who's getting the money? Now, this is a big one. And it's a factual question. You can say, well, have you actually updated your beneficiary nomination forms? It would surprise you. And if I could just go back a slide, the marriage and separation up in the top right corner there, marriage and separation is an opportunity as a mortgage broker, finance broker, for you to shine. And that is because you will ask the question when they say to you, well, I'm separating from my partner, we're getting divorced. Again, after offering condolences, you can say, have you updated your beneficiaries on your life insurance policy? This is really important because you can imagine that, and there are cases that have been, and lawsuits that have been lodged over this stuff and filed over this stuff, where a former spouse didn't update their beneficiary nominations, and all of the, we have another person joining, and all of the benefit from the life policy went to the ex-wife. And you can imagine the horror in the family that around that situation. And of course, it's always the ex-wife was a real nutter and da-da-da-da. There's a whole backstory behind it. And you know what? It's tough for that family because all they had to do was be asked the question, have you updated your beneficiary nominations? And they update them, and then that problem goes away. Or maybe not goes away completely, but it certainly gets addressed and dealt with. Will there be taxes that apply? We've talked a little bit about income protection and taxes, so you do pay tax on the benefit. And this is a big one, reducing or stopping cover. I often get asked this by clients. At what time in their lives could they reduce or even eliminate cover? I'm almost going to be cheeky and say, well, probably never, because interestingly, with life insurances, those can become an estate planning tool down the track, especially if you have a guaranteed renewable policy to age 99. So even though you turn, you stop working and you turn 65 or age to 65 and beyond, you can still retain life cover. And if it's a substantial type of policy, there's strategies around having, again, I'm not going to go into this today, but having other companies pay your premium. They, of course, will take a portion of the life benefit when you pass away, but using that as a tool to help your next generation, or maybe even skip your kids and go to the grandkids. And if you live a really long life, maybe even the great grandkids. So there's some interesting things around that and strategies around that. But I generally will say to people, let's first look at if you want to reduce cover, this is the question or the thing that I say to them that they should go and do, especially around life cover and especially around income protection. I say, go and get a full physical. Go to the doctor and have them run every single test, poke and prod you with every single thing they can poke and prod you with, and find out whether you have any health issues that you might not outwardly have noticed, or maybe you feel okay, but maybe there's something going on in your body that just isn't one of those. It's not a pain, but there's something in your body happening. Go and do that, and if you get the all clear after doing all that, then we can have a conversation. I have heard stories. I was recently at a specialist risk insurance day, and this whole concept was developed, and somebody was a risk writer was talking about this very thing, and I went, that is brilliant. And he told a couple of stories where clients, fair income, went into the doctor, were about to cancel a policy, followed the advice of the advisor, went in, got a full test run and everything else, and had some illness that was going to wipe them out, kill them terminally. Or they just had some illness that actually knocked them about for a period of time. And had they canceled their insurance, that event would have eventually happened, and they wouldn't have had any cover. So again, if somebody came to me and said, we want to reduce or stop our cover, I would say, go and see the doc and get a full exam. All right, just to wrap things up, we are near the end. The question, hopefully, now is not do I like insurance, but it is, can I see the value, or do I see the value in offering my clients to have a conversation about it? Again, if you're not licensed to give advice in this space, don't have deep conversations with them. Talk to them about factual things. But again, importantly, if you can have an advisor that you can refer to for this type of business, you will look like a superstar. The chances of one of your clients having an event in the next few years is quite high. I don't know the exact stat, but something like 2 out of every 3 people in a large room will have some form of insurable event occur in their lifetime. And that's pretty telling, and the stats bear that out. So just the cascade effect. So, if something really seriously happened to you, well, who's going to carry the burden? Well, first of all, if it's you, can you carry that burden? Probably not for very long. Then it goes to your family. What are their resources? Are they able to help, and how much? You then exhaust savings. You then go to super. If you're lucky to have a business as well, the business gets sold, and then I suppose finally you have the insurer. I would rather reverse this and start with the insurer. So if something were to happen to you, you as quickly as possible want to have the insurer carrying the financial cost of whatever comes next. So with that, we'll wrap up. Again, a few tips. Simple questions. Ask your client, show me your super. I want to see what insurance coverage you have in your super. And you can ask them as well, do you have any retail insurance policies, and what are they? Just take a note of it for future reference. Recording the sums insured, ask about wait periods, ask about benefit periods. That's not advice, that's info or fact gathering. This is a biggie. Ask yourself, I suppose, whether their cover matches to where they are in their life stage. So by life stage, I mean, are they a young family with young kids just starting out? Are they in the middle of life where they're kind of at peak debt, peak school fees, peak expenses? Are they at the latter stage of life where their assets might be, or their debt might largely be paid off, but they still have goals and desires to help their family out? And then, of course, finally, as I've been saying throughout this presentation, get someone who is licensed to provide advice and partner with you to have those conversations. It's real important. I can't say this enough. It's so important for you to have a financial advisor that you can trust, that you have a good relationship with, that you can refer to. So with that, I will say thank you for attending this webinar.